Alright, so July 2026 is here, and if you're getting age pension, or you've been thinking about whether you even qualify, there are some real changes that happened on the 1st of July that you actually need to know about. Now I want to be upfront with you. The full pension rate itself hasn't changed. I'll explain why in a second. But here's the thing, a lot of people are going to see more money coming in, or they are going to suddenly qualify for a pension they didn't qualify for before. And if you tune out because the headline number stayed the same, you might completely miss something that's worth hundreds, maybe even thousands of dollars a year to you. So stick around. We are going to go through everything: the eligibility requirements, the current full pension rates, the new assets test thresholds, the new income test limits, deeming rates, the work bonus, all of it. Let's get into it. Before we talk about how much you can get, let's quickly cover who can actually get it, because none of the rest of this matters if you don't meet the basic requirements. There are 3 things Centrelink looks at. First is your age. You need to be at least 67 years old. That's the current qualifying age, and it applies to everyone right now regardless of when you were born. Second is residency. You need to have lived in Australia for at least 10 years total. But it's not just about the total, at least 5 of those years need to be continuous, meaning no long breaks in between. If you've moved around a lot internationally, this is worth checking carefully because it catches people out sometimes. Now those first 2, age and residency, they are pretty straightforward yes or no questions. Either you meet them or you don't. The third one is where it gets more interesting, and that's means testing. This is what determines how much you actually receive. Centrelink runs 2 separate tests on you. They look at what you earn through the assets test, and they look at what you earn through the income test. Each test produces a different pension figure. Whichever one gives you the lower pension, that's the one they use. So both matter. Okay, so here's why the full pension rate didn't change on the 1st of July. The full rate is only updated twice a year, in March and in September. Specifically on the 20th of March and the 20th of September each year. July doesn't fall in that window, so whatever the rate was as of March, that's what it stays until the 19th of September. Right now, from now until the 19th of September, the full age pension is: for singles, it's $1,200.90 per fortnight. That works out to about $31,223 a year. For couples, each person gets $905.20 per fortnight. That's roughly $23,535 per person per year. Those figures already include everything: the base pension, the pension supplement, and the energy supplement. So that's the full picture, nothing extra hidden in there. Now here's something people don't always realize. If you receive even $1 single of age pension, just $1, you automatically get issued a pensioner concession card. And that card is worth taking seriously. We are talking discounts on prescription medicines, lower rates on some utility bills, reduced costs on public transport, cheaper council rates in some areas, and a bunch of other things depending on where you live. For some people, the card alone saves them more money each year than the pension itself. So even if the pension amount seems small in your situation, the card that comes with it has real value. If you rent privately and you receive age pension, you may also be getting rent assistance on top of that. Just so you know, the rent assistance amounts haven't changed either, same reason. It only gets updated in March and September. The way it works is there's a minimum rent threshold. Once your rent goes above that threshold, for every dollar you pay over it, you get 75 cents back from Centrelink. But there's a cap, a maximum amount you can receive. The exact numbers depend on whether you're single or in a couple, but the structure is consistent. Nothing changes there until September. Just wanted to flag it so you're not waiting for something that isn't coming in July. Right, so here's where July 2026 actually does change something meaningful. Both the lower and upper thresholds of the assets test have gone up. Let me explain what these thresholds mean for those who aren't familiar. The lower threshold is the value of assets you can have and still receive the full pension. If you're below that number, you get everything. The upper threshold, sometimes called the cutoff limit, is the point at which your pension drops to zero. In between those two numbers, your pension reduces gradually. So from the 1st of July 2026 through to the 19th of September 2026, the thresholds are: if you own your home, singles can have up to $333,000 in assets and still receive the full pension. For couples, that combined limit is $499,000. If you don't own your home, the limits are higher. Singles can have up to $600,000. Couples can have up to $766,000 combined. One important thing to be clear on: your family home is not counted in the assets test if you're a homeowner. The house you live in doesn't go into that number. That's why non-homeowners have higher thresholds, because they don't have that protection, so Centrelink accounts for the fact that they might have savings or investments in place of what a homeowner has tied up in property. Now, what happens once you go over the lower threshold? For singles, every $1,000 you have above the limit reduces your pension by $3 per fortnight. For couples, it's $1.50 per person per fortnight for every $1,000 over the limit. And once your assets hit the upper cutoff point, that's it, pension stops entirely. The good news is that these thresholds going up means some people, who were just over the limit before, are now under it. That means more money for them, either getting a bigger part pension, or suddenly getting the full pension. And for people who were already on a part pension, the increase in the lower threshold could push them into full pension territory too. The income test thresholds have also gone up. The increase is modest, $8 per fortnight for singles and $16 per fortnight for couples combined, but it does move the needle. Here's where things stand from the 1st of July. If you're single, you can earn up to $226 per fortnight before your pension starts reducing. Above that, every dollar you earn cuts your pension by 50 cents. Once your income hits $2,627.80 per fortnight, the pension stops. If you're in a couple, you can earn up to $396 combined per fortnight before it starts affecting things. Above that, every dollar reduces each person's pension by 25 cents. The pension cuts off completely when combined income reaches $4,016.80 per fortnight. Now, the reason the reduction is slower for couples is that the taper rate is shared across two people, so the individual impact is less per person. This one confuses a lot of people, so let me break it down clearly. Deeming is a concept Centrelink uses for financial assets, things like money in bank accounts, shares, managed funds, and superannuation. Instead of looking at what those assets actually earn, because that would be complicated and easy to manipulate, Centrelink just says, we are going to assume your financial assets earn a set percentage, and we'll use that assumed figure as your income for the income test. That assumed rate is the deeming rate. There are two deeming rates: 1.25% on assets up to a certain threshold, and 3.25% on everything above that threshold. Both of those rates are unchanged from before. They haven't moved. But what has changed from the 1st of July is the threshold that divides which rate applies. That threshold has gone up by $2,600 for singles and $4,400 for couples compared to last year. What that means in practice is that more of your financial assets are now assessed at the lower 1.25% rate before the higher rate kicks in. So your deemed income, the income Centrelink assumes you're getting from your savings and investments, goes down a little. And when your deemed income goes down, your income test result is lower, which could mean a higher pension payment if you're being assessed on income. It's not a dramatic change, but if you have a decent amount in savings or super, this adjustment can make a real difference to what Centrelink counts against you. Some of you are still working while receiving the pension, and there's a specific rule that helps you out. It's called the work bonus. The work bonus allows you to earn up to $300 per fortnight from employment without it counting toward your income test at all. That means if you're doing some part-time work, some consulting, or running a small business where you're actively involved, the first $300 each fortnight is completely invisible to Centrelink from an income perspective. But here's the really useful part. If you have a period where you don't work at all, no employment income, that unused $300 doesn't just disappear. It builds up in what's called a work bonus balance. That balance can grow up to a maximum of $11,800. So if you took a few months off and then went back to work and earned a bit more than usual, you'd have that buffer sitting there to absorb it. On top of that, depending on when you first claim the pension, you might get a one-off boost of $4,000 added to your work bonus balance straight away. That gives you a real head start. One thing worth knowing, the work bonus only applies to employment and self-employment income. If you've got rental income coming in, or dividends, or income from a passive business arrangement, that does not qualify. It has to be from actual work you're doing. You don't need to apply for it. It's automatically applied when Centrelink assesses your income. And you can check your current work bonus balance through your Centrelink online account if you want to keep an eye on it. Let's pull this together and talk about what July 2026 actually means for different types of people. If you're already on the full pension, your payment isn't changing in July. That happens in September. Nothing for you to worry about right now. If you've been getting a part pension, meaning your assets or your income reduced what you were getting, there's a good chance the threshold increases push your situation in a more favorable direction. Either you get a bit more per fortnight, or in some cases you tip over into getting the full pension. Either way, worth checking your statement. If you missed out before, maybe you were just slightly over the assets limit, or slightly over the income limit, July's changes might be the thing that brings you into qualifying territory. Even a small pension is worth having, not just for the money, but for that pensioner concession card we talked about earlier. That card can be worth more than the pension to some people. And if you're income tested specifically, meaning it's your income that determines your pension rather than your assets, the combination of the higher income thresholds and the improved deeming threshold both work in your favor. That's the full picture for July 2026. I know there's a lot in there, but honestly this stuff is worth understanding properly because small changes in thresholds can genuinely have a big impact on what ends up in your account each fortnight. If you want to go deeper on how to actually maximize your age pension, not just understand the rules, but use them properly, I've got videos on that too. There are strategies around timing, around how assets are structured, and around the work bonus that a lot of people just don't know about. Make sure you subscribe so you don't miss those. And if you've got questions about your specific situation, drop them in the comments. I read them all. Thanks for watching. See you in the next one.